Preparing for a PepsiCo FP&A Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a consumer goods company like PepsiCo? FP&A connects PepsiCo's operating decisions with financial performance. I would support budgeting, rolling forecasts, monthly reporting, and variance analysis while partnering with sales, marketing, supply chain, and operations. In FMCG, the role requires understanding volume, pricing, mix, promotions, input costs, and distribution. I would not simply explain historical results. I would identify risks, quantify opportunities, and recommend actions that improve profitable growth, cash flow, and forecast accuracy. While answering, focus on planning, forecasting, performance analysis, business partnering, decision support, cash generation, and translating operational activity into financial outcomes across brands, categories, channels, and markets. Question 2. How would you build a sales forecast for a PepsiCo product category? I would begin with a driver-based baseline using historical volume, pricing, mix, seasonality, distribution, and customer-level trends. Then I would layer in promotional calendars, innovation launches, planned price increases, competitive activity, and retailer assumptions. I would validate the forecast with sales and marketing, challenge unsupported optimism, and document each assumption. Finally, I would create upside and downside scenarios so leadership can understand both the expected result and the key risks. Make sure to cover historical run rates, volume drivers, price and mix, seasonality, promotions, distribution, customer plans, market data, assumptions, stakeholder review, and sensitivity analysis. Question 3. Explain the difference between a budget, forecast, and outlook. A budget is the formally approved financial plan and typically establishes annual targets and resource commitments. A forecast is an updated estimate of likely performance based on current information, while an outlook can be a shorter-term or less formal view of where results are heading. I use the budget to measure performance, the forecast to guide decisions, and the outlook to highlight emerging risks. Keeping those purposes separate prevents teams from confusing targets with realistic expectations. In your answer, distinguish the fixed annual target from the latest expectation, explain update frequency and purpose, and connect each tool to accountability, resource allocation, performance evaluation, and corrective action. Question 4. How would you analyze a revenue miss versus forecast? I would first quantify the gap and bridge it into volume, price, mix, foreign exchange, and timing. Then I would drill into brands, customers, channels, markets, and promotional events to identify the operational cause. For example, lower revenue could reflect shipment timing rather than lost demand. I would validate the explanation with commercial teams, update the forecast if the issue persists, and recommend actions such as revised promotions, pricing, or inventory allocation. Be sure to mention decomposition into volume, price, mix, foreign exchange, timing, customer, brand, and channel drivers, followed by root cause validation, outlook revision, and corrective actions. Question 5. What is price volume mix analysis, and why is it important in FMCG? Price volume mix analysis explains how revenue changed beyond a simple period-over-period comparison. Volume measures the effect of selling more or fewer units, price captures changes in realized selling prices, and mix reflects shifts between products, pack sizes, customers, or channels. I would apply a consistent bridge and reconcile it to reported revenue. In FMCG, this matters because strong pricing can mask declining volume, while unfavorable mix can pressure margins despite revenue growth. Focus on separating revenue changes into selling price, units sold, and product or channel mix, explaining interaction effects, and linking findings to commercial decisions and gross margin performance. Question 6. How would you investigate a gross margin decline at PepsiCo? I would bridge gross margin from the prior period using price, volume, mix, commodities, packaging, labor, freight, manufacturing efficiency, promotions, foreign exchange, and overhead absorption. I would compare actual cost per unit with standards and determine whether the pressure comes from input inflation, unfavorable mix, or execution. Then I would assess mitigation, such as pricing, sourcing, productivity, or pack architecture. The key is distinguishing a timing issue from a structural margin problem. Make sure to cover revenue drivers, commodity and packaging costs, manufacturing efficiency, freight, promotions, product mix, foreign exchange, overhead absorption, and whether the issue is temporary or structural. Question 7. How do promotions affect an FMCG forecast and profitability? Promotions can increase shipments but do not automatically create profitable growth. I would estimate baseline volume, incremental lift, discount depth, retailer funding, trade spend, cannibalization, and post-promotion demand decline. I would evaluate net revenue and contribution margin, not just gross sales. For example, a deeper discount may produce strong volume but destroy margin. I would compare actual promotional effectiveness with the original plan and incorporate the learning into future forecasts. In your answer, discuss baseline demand, incremental volume, discount depth, retailer funding, cannibalization, trade spend, promotional timing, post-promotion effects, and contribution margin rather than revenue alone. Question 8. What is trade spending, and how would you forecast it? Trade spending represents commercial investment supporting retailer sales, including discounts, rebates, displays, and promotional allowances. I would forecast it using customer agreements, expected shipments or sell-through, promotional calendars, historical settlement patterns, and planned rate changes. I would maintain accruals consistently, reconcile them to invoices and claims, and investigate unusual balances. The analysis should show both the expense impact and the incremental volume or margin generated by each major program. Be sure to mention retailer agreements, discounts, rebates, displays, accrual methodology, shipment or sell-through drivers, actual settlements, contract changes, and reconciliation between commercial plans and accounting records. Question 9. How would you prepare for a monthly forecast or operating review? I would start by confirming actuals, forecast versions, and key data sources are complete and consistent. Next, I would prepare bridges for revenue, gross profit, operating expenses, and cash flow, highlighting the largest drivers rather than every variance. I would align assumptions with sales, supply chain, marketing, and operations before the meeting. Finally, I would summarize risks, opportunities, decisions required, and owners, so the review leads to action instead of merely reporting history. Focus on data integrity, actual versus plan analysis, driver bridges, risks and opportunities, assumption ownership, management questions, concise visuals, and clearly defined actions with accountable owners. Question 10. Tell me about a time you improved forecast accuracy. In a previous role, forecast accuracy was weak because teams used inconsistent assumptions for customer demand. I created a standardized driver-based template separating baseline volume, promotions, pricing, and distribution changes. I reviewed the assumptions monthly with commercial owners and tracked forecast error by customer and category. Over 2 cycles, accuracy improved materially and the review became faster. The lasting improvement came from clearer ownership, documented drivers, and measuring bias rather than relying on judgment alone. Make sure to structure the response with situation, analysis, action, measurable result, stakeholder collaboration, and a sustainable process improvement rather than claiming accuracy improved through extra effort alone. Question 11. Which KPIs would you monitor for PepsiCo's FMCG business? I would monitor organic revenue growth, volume, net pricing, product and channel mix, market share, gross margin, operating margin, trade spending, and selling and administrative costs. Operationally, I would also track inventory days, service levels, out of stocks, production efficiency, and cash conversion. The right KPI set connects commercial activity with profitability and cash. I would segment results by brand, category, customer, and geography to avoid hiding weak performance behind consolidated averages. In your answer, include organic revenue growth, volume, pricing, market share, gross margin, operating margin, trade spend, inventory, service levels, cash conversion, and forecast accuracy. Question 12. How would you explain an unfavorable operating expense variance? I would first compare actual spending with both budget and latest forecast, then classify the variance as timing, volume-driven, rate-driven, foreign exchange, discretionary, or structural. I would check purchase orders, invoices, accruals, headcount, and allocation logic before drawing conclusions. Then I would discuss controllable actions with the expense owner, such as delaying non-essential spend or correcting staffing assumptions. I would communicate whether the variance reverses, persists, or requires a forecast adjustment. Focus on separating timing, volume-driven, rate-driven, FX, discretionary, and structural items, validating accruals, identifying controllable actions, and updating the forecast with a clear management message. Question 13. How would inflation in commodities and packaging affect your forecast? I would quantify the exposure by material, volume, supplier, currency, and contract coverage. Then I would assess hedging, purchase commitments, expected market prices, productivity, reformulation, and timing. On the commercial side, I would model pricing actions, elasticity, customer negotiations, and potential volume or mix effects. I would present base, upside, and downside cases showing revenue, gross margin, and cash consequences. This allows management to balance price recovery with competitiveness and demand protection. Be sure to discuss cost assumptions, hedging, supplier contracts, purchase timing, productivity, pricing recovery, elasticity, margin impact, scenarios, and coordination with procurement and commercial teams. Question 14. What is working capital, and how would you forecast it? Working capital is the cash invested in operating balances, primarily receivables, inventory, and payables. I would forecast receivables using sales and collection days, inventory using demand, production plans, safety stock, and inventory days, and payables using purchases and payment terms. I would incorporate seasonality, promotions, supply constraints, and obsolete inventory risks. The analysis should identify cash release actions, such as improving collections, reducing excess stock, or negotiating supplier terms. Mention accounts receivable, inventory, accounts payable, days metrics, seasonality, promotions, production plans, payment terms, obsolete stock, cash conversion, and operational actions that release cash. Question 15. How would you evaluate whether a new product launch is financially attractive? I would build an incremental business case covering expected volume, net price, mix, cannibalization, trade spending, advertising, distribution, manufacturing costs, and working capital. I would calculate contribution margin, break-even volume, payback, and sensitivity to slower distribution or lower repeat purchases. I would separate assumptions from commitments and compare the launch with alternative uses of marketing and capacity. A compelling launch should create incremental profitable growth, not simply shift sales from an existing product. Focus on incremental volume, price, cannibalization, trade investment, marketing, manufacturing costs, distribution, working capital, contribution margin, break-even timing, and scenario-based return analysis. Question 16. How would foreign exchange affect PepsiCo's forecast and variance analysis? I would distinguish transaction exposure, where foreign currency costs or revenues create an economic impact, from translation exposure when international results are converted into the reporting currency. I would identify currency-sensitive revenue and costs, apply approved rates, and separate constant currency operating performance from reported results. I would also consider hedging coverage and timing. The final bridge should show what management can control operationally versus what reflects exchange rate movement, preventing misleading performance conclusions. In your answer, distinguish transaction and translation effects, identify exposed currencies, separate constant currency performance, consider hedging, and explain implications for revenue, costs, earnings, and cash. Question 17. What checks would you perform before submitting a forecast? Before submission, I would confirm the correct forecast version, period, currency, and organizational hierarchy. I would reconcile revenue and expense totals to source systems, test formulas, review unusual movements, and compare key drivers with historical trends and operational plans. I would check intercompany consistency and confirm that assumptions have owners and evidence. Finally, I would obtain stakeholder sign-off and preserve a clear audit trail so changes can be explained during review. Be sure to mention data completeness, version control, reconciliations, formula checks, trend analysis, reasonableness tests, intercompany consistency, stakeholder sign-off, and documented assumptions for auditability. Question 18. How would you respond if sales disagreed with your forecast? I would first understand which assumption drives the disagreement, such as distribution, customer demand, promotional lift, or timing. Then I would compare the sales view with historical performance, external indicators, retailer commitments, and available operational evidence. Rather than forcing one answer, I would show a base case and sensitivities, documenting the rationale for each. If the difference were material, I would escalate it transparently. My goal is an accurate, decision-useful forecast, not winning an argument. Focus on listening first, comparing assumptions objectively, using data and sensitivities, separating targets from expectations, documenting judgment, escalating material differences, and preserving a constructive business partner relationship. Question 19. Describe how you would use Excel or financial systems in an FP&A role. I would use Excel for driver-based models, reconciliations, scenario analysis, pivots, lookups, and concise management bridges, while using Power Query or similar tools to reduce manual data preparation. I would connect outputs to ERP and planning systems where appropriate and build checks for missing data, duplicated records, and unexpected movements. The objective is not a complicated spreadsheet. It is a controlled process that produces reliable analysis quickly and supports better decisions. Mention structured models, pivots, lookups, Power Query or automation, scenario tools, error controls, ERP and planning system integration, data visualization, and communicating insights rather than merely producing spreadsheets. Question 20. Why do you want to join PepsiCo as an FP&A analyst? PepsiCo appeals to me because its scale and portfolio create a rich FP&A environment where finance is closely connected to brands, customers, supply chains, and consumers. I want to apply my analytical skills to forecasting, variance investigation, and profitable growth decisions while learning from experienced business partners. The FMCG setting is especially attractive because small changes in pricing, volume, mix, or promotions can materially affect results. I would bring curiosity, discipline, and clear communication to the role. In your answer, connect PepsiCo's scale, portfolio, brands, international complexity, data-driven culture, and growth opportunities with your analytical skills, commercial curiosity, and commitment to developing as a finance partner. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.